Welcome to the debate. As we turn the calendar to 2026, the U.S. equity market presents a truly historic paradox. We have valuations that have soared to, well, to statistical extremes, levels previously associated only with peak financial exuberance. And this latest ascent is, I think we can all agree, undeniably driven by the profound secular promise of artificial intelligence. So the central question before us is critical. Do these historically reliable metrics, the Buffett Indicator, the Shiller PE, do they still retain their predictive power and signal an imminent, significant market correction? Or have the structural economic changes from AI and globalization fundamentally rewritten the laws of financial gravity? I'm going to argue that the evidence for mean reversion it's overwhelming. The risks are at their maximum, and prudence mandates we prepare for a sharp valuation reset.
And I'll come at it from a different way. While the raw numbers certainly flash extreme warning signs, and I don't deny that, I believe looking at these traditional indicators in isolation is, well, it's a historical failure to adapt. We can't simply compare the 2026 AI-driven peak to, say, the 2000 .com episode without appreciating the underlying structural differences. I contend that these extreme valuation levels are structurally distinct and largely explained, if not justified, by the immense high-margin productivity potential priced into a highly concentrated group of globally dominant companies. This is a new paradigm, and we have to acknowledge the market has undergone a permanent repricing.
Okay, but we have to start with what the data objectively measures, because the sheer weight of historical evidence, it demands caution. The convergence of what I call the big three indicators, it signals maximum theoretical risk. The first one is the Buffett Indicator, right? Market capitalization to GDP. As of January 1st, 2026, this stands at an astonishing all-time high of 222%. I mean, I want to unpack that for a moment. To put that into perspective, that reading doesn't just surpass the 2000 .com peak of 159%. It sits a staggering 2.4 standard deviations above its historical mean. You know, what does a 2.4 standard deviation divergence really mean for portfolio construction? It implies that the odds of avoiding a significant correction from this level are approaching the zero bound. The market's price is simply detached from the underlying economic output of the nation. The second metric, the Shiller PE ratio, which uses cyclically adjusted earnings over a 10-year period, it is now at 39.42.
Right.
This is territory we've only seen once before in history, during the final months of 1999 and early 2000, which, as we all know, preceded a decade of painful, negligible, or even negative real returns. And finally, look, if you don't trust the indicators, just look at the money itself. The ultimate financial bellwether, Warren Buffett, he's been acting on this. He was a net seller of equities for 12 consecutive quarters, right up to his retirement at the end of 2025, accumulating a massive $381.7 billion cash fortress. His actions clearly signal his view that the expected S&P 500 returns at this price level are inferior to the risk-free rate.
That is a highly structured and frankly compelling argument. But I would argue that your foundation, the use of US GDP as the sole denominator, is fundamentally flawed when you're analyzing the S&P 500 in 2026. My take on this is that the valuation metrics themselves are suffering from what I'd call the denominator dilemma. First, let's just address the mechanism driving that 222% number. It's the AI decoupling. This is fundamentally different from previous bubbles. We saw over $400 billion in capital expenditures just last year, in 2025, all related to AI infrastructure. These are investments made by a handful of mega-cap firms that create immediate market capitalization based on future productivity promises, not current, measurable domestic output. This massive CapEx creates a feedback loop that inflates the tech market cap. Second, the global revenue thesis has to contextualize the Buffett Indicator. The S&P 500 is not a domestic index. These companies generate roughly 40% of their revenue abroad.
I understand that point.
So comparing their massive global valuations solely against US GDP is, well, it's misleading. We're judging a global powerhouse by a regional standard. And finally, yes, the valuation looks stretched, but the forward guidance is unprecedented. Projected secular earnings growth from this AI supercycle is estimated at 13 to 15%. If that materializes, Earnings, the denominator in every PE calculation, could rapidly catch up to the elevated prices over the next few years. You're assuming the numerator, the price, must fall. I argue the denominator, earnings, may rise dramatically to meet it.
I see why you think that the structural changes in the global revenue profile negate the indicators, but let me return to the most basic principle of finance, the appropriate pricing of risk. Right now, the market is completely disregarding that principle. Let's dissect the equity risk premium, or the ERP. The earnings yield on the S&P 500, so the inverse of the PE, is currently 3.59%. Now compare that to the 10-year Treasury yield at 4.18%. That calculates out to a negative ERP of negative 0.59%. This specific gap, where you are compensated less to take on the volatility and risk of a stock than you are for holding a guaranteed government bond, that is a textbook hallmark of speculative mania. It signals not structural repricing, but deep irrationality.
Okay, and that negative ERP is devastating, I grant you. From a pure valuation sheet, it absolutely screams irrationality. But I'd counter that investors are intellectually aware of the risk, which leads to a kind of sentiment paradox that is different from previous bubbles. Previous bubbles were defined by euphoria. This rally, it feels like it's defined by fear. Look at the secondary indicators. The CNN Fear and Greed Index registers 44. That places it firmly in fear territory, despite these record-high valuations. This is a hated rally. Investors aren't participating out of conviction. They are participating out of a profound fear of missing out, a FOMO, driven by the concentration risks in the dominant tech sector. They're intellectually cautious, but behaviorally forced into it. Furthermore, the VIX, the market's volatility gauge, is closing at a deeply complacent 14.95. So investors aren't hedging, they're just focused on the momentum continuing.
That psychological strain is just the pressure building before the release. I mean, momentum trading is never sustainable when it's divorced from underlying value. Let's pivot to the macroeconomic signals, which are far less ambiguous than investor psychology. We need to discuss the yield curve. The curve has emphatically uninverted to a positive spread of 71 basis points. This follows a historic 16-month inversion that saw a deep trough of negative 108 BPS back in 2023. This pattern, where short-term rates drop faster than long-term rates, is what we call bull steepening. And this bull steepening is historically, well, it's problematic. It shows the Fed is aggressively pivoting to easing and cutting rates, typically not because the economy is robust, but because policymakers are panicking about imminent weakness. We saw this precise signal right before the 2000-2001 recession and again before the 2006-2007 financial crisis. The market often peaks after the curve uninverts, but before the recession is officially declared. It confirms the backdrop is precarious.
That's an interesting point about the historical precedent, but I would frame the uninversion differently based on the current driver of the change. Yes, history warns us, but we have to consider the policy context. The 2-year yield has dropped so sharply because the Fed has aggressively pivoted and cut rates to the 3 to 3.25% range. Primarily to combat weakness in the labor market, unemployment is already rising. It's at 4.4%. So this specific type of steepening could very well be supporting the soft landing slide scenario, which many analysts peg at a credible 30% probability, rather than your high probability mean reversion crash. Policy easing might just stabilize the economy enough to allow the market to trade sideways.
And if we trade sideways, that projected 13 to 15% earnings growth from AI starts to materially temper those extreme valuation ratios without the need for a sudden destructive crash. You are predicting a violent correction. I'm suggesting the economy might limp along, letting the math gradually improve.
Trading sideways at these valuations still means years of negligible real returns. That outcome, even without a crash, is punitive. And regardless of the soft landing debate, the valuation extremes mandate a serious discussion about liquidity and global diversification. The data shows clear, profound global dispersion. The U.S. Buffett Indicator, 222%, is in a speculative stratosphere, whereas Germany is around 44% and Brazil is roughly 30%. This suggests U.S. exceptionalism is purely a pricing phenomenon right now. And let's talk about the physics of mean reversion. Invesco's model suggests a 34% decline in the S&P 500 is required just to return the Shiller PE from its current level back to its long-term mean of about 25. That's the cost of restoring historical normalcy. Can the AI narrative offset that financial gravity? I seriously doubt it.
See, I'm not convinced by that because it treats the mean as a fixed, immutable constant. I fundamentally challenge the inevitability of that 34% decline. If we look back, the Buffett Indicator has forged permanent higher highs over time, 159 in 2000, 193 in 2021, and now 222 in 2026. This trend suggests the U.S. market has undergone a structural, permanent repricing due to the unique, high-margin, scalable nature of our technology sector, which attracts global capital at a permanent premium. The highest margin companies in the world are listed here. So while I'd acknowledge the value in global rotation for diversification, that's always wise, dismissing the structural reasons for the current 222 reading based on prior non-AI-driven cycles is a failure to adapt. The market is suggesting that the global mean has shifted permanently upward, and the U.S. is simply commanding the highest premium within that new reality.
The evidence for a historical reckoning is overwhelming. Regardless of the AI narrative, the three major indicators, the Buffett Indicator at 222%, Shiller PE near 40, and the confirmed pre-recession yield curve signal, they all point toward the high probability, approaching 50%, of a significant market reckoning in 2026. Prudence dictates heeding the action of smart money, specifically Buffett's immense cash pile, over the crowd's momentary momentum.
But the complexity of this particular market cycle requires more than a rigid application of 50-year historical averages. While the valuations are extreme, the unique nature of this AI decoupling and the global revenue profile of U.S. corporations, they suggest that a simple violent return to the 17 times Shiller P average is unlikely without an unprecedented earnings collapse. The critical debate remains whether our traditional valuation models are flawed or if the market is simply pricing in a future that may yet fully materialize.
I think we both agree fundamentally that risk is acutely high, and that 2026 is likely to be defined by increased volatility and potentially painful concentration risk.
Absolutely. The substantive disagreement centers on the magnitude of potential future earnings growth versus the immutable laws of valuation, or rather, whether those laws have been permanently bent by technology. And that is the question the listener must now weigh in light of the evidence presented.